purchase IBM stock at $225 or $235, you're going to be paying $100 more than you sold that contract at. So we never sell what they call naked options, options that do not have any protection on them. No. What we do is we provide, we create strategies, mostly through spreads, that allow us not only to collect the premium, but to protect ourselves in case of a takeover or something like that. And actually, most of our strategies do not focus around individual stocks. We tend to, almost all of our strategies are on indexes that can't be taken over because we do not want that price risk. So let's say we want to do something on IWM. IWM is the ETF for the Russell 2000 index. Well, nobody's going to take over the Russell 2000 index. There's 2,000 stocks in that index. One or two of those stocks may get a takeover bid, which may slightly affect the price of the index, but not dramatically. However, the prices, remember, there's two rules. Prices will fluctuate, and options they will expire. So let's say we wanted to capture 82 cents, or this May 74. We wanted to sell this option for 78 cents. Well, if we wanted to collect as much premium as possible, what could we do to protect ourselves? Well, if we thought there was some danger that the Russell 2000 index, which we can also take a look at a graph of, the Russell 2000 index now has been trading downward. However, it looks like it may be turning around. So if we think it's going to remain in some sort of trading range, all we have to do is sell this contract, collect 78 cents. But if we want to protect ourselves so that we don't get hurt if it does go up dramatically, then we can also buy a contract just slightly above our 74 cents. Or $74 strike price, and now what we have is a spread. So in other words, if the Russell 2000 index does not go above 74, we get to collect and keep that entire 78 cents that we just sold that contract for, but we had to pay for protection, and that protection cost us 50 cents. So the difference between the 78 cents and the 50 cents is 28 cents, which we get to keep. That's how much we will get to keep. Now you say, well, why would you buy protection? Well, because, like I said, even with an index, the price can fluctuate dramatically. And if it goes up to 79 or 80, now all of a sudden the contract that we sold at 74, if it goes up to 80, is worth $6. And if it's worth $6, we've lost $5.22. So we'd have to pay out $5.22, which is not a pleasant thing to do. However, if we protected ourselves by buying the $75 contract, that $75 contract is also worth $5. So the maximum that we could lose on this contract is the difference between the 74 and the 75, which is only $1. So the maximum loss is not $6.22, but because we've protected our short position with a long position on the same underlying index, now the maximum loss is only the difference between these two strike prices, which is $1. And I can show you exactly how this works. Normally what we do when we go to enter orders like this is we would go and we would right-click on these in the TOS platform. And what we're doing is we're selling a vertical spread. This is called a vertical spread. The same month, same index, and same underlying. As you can see, we're getting the difference between the 78 cents and the 50 cents. Now the natural price is 28 cents credit, but we can also try to get a little bit better. We want a little bit, if we wanted a little bit more credit, we could try it at the mid price. But the natural price the difference between these two options is 28 cents. So we would get to keep that 28 cents. We're just going to keep this at one contract for now just to show you what we're going to be doing here. If we were to simply enter this, we would receive a credit of $22.10. We can also take a look at a graph. If we go to anywhere within this little red area here, right-click on that and go to Analyze Duplicate Trade, we can actually take a look at a graph of what the profit of this would look like. Let me just go back here because I had some other things in there. If we go to, we want to take a look at how profitable it will be at expiration. And as you can see, we collected $22 after commissions, and you can tell that the price is right here. And as long as the price does not exceed 74, which is the exact strike price of our short option, the option that we're selling, as long as it doesn't go above that and the stock remains lower than that, we make the full profit amount. And it doesn't matter how low this stock goes. We collect the entire premium. It's only if it goes above the price at which we sold it that we begin to look at a potential loss situation. So we can graph all of our positions in the TOS platform. Normally, what we like to do is not do one-sided trades like this, because what would happen if, for example, we sold the May 74 option, we bought the May 75 option as protection, like we're doing here. This little plus symbol in front of the number of contracts means that we're buying it, which it says here, buy. We're selling one of the May 74 calls for a 28-cent credit. We get to keep that credit. But we normally don't do anything one-dimensional like that. We also like to take a look at the put side because, and this is one of the tenets of our system, is that we do not know where price is going. We just don't know. We maybe have some ideas. If we take a look at this graph going back about a year, we can tell that the Russell 2000 index is, kind of going down, but, lately it's kind of been going up. So we don't really know what's going to happen to the price. And this is really critical to understand as far as the system goes. We do not try to predict price. Price fluctuates. That is the only rule. No matter what you say about any particular stock or any particular index, there's only one rule in the financial markets. Prices will fluctuate. And it doesn't matter how long you go back. You can go back 5 years. You can go back 10 years. Prices go up and they go down. They go up and they go down. Now you might be able to determine certain types of trends, like from 2000 to 2003, the trend was down. From 2003 up